Most people assume that retiring at age 60 or 65 is the safer financial decision. You generate income for more years and you get more time to invest. More years of contributing to your retirement accounts. Seems obvious, right? But what if retiring after 60 isn't actually the best financial decision? What if retiring earlier actually leaves you with more money after taxes? And how early are we talking? 56, 52, or even 48? Because the year you retire doesn't just determine how much money you have, it also determines how much control you have over your taxes for decades to come. So today I want to answer a question that almost nobody asks. If your goal is maximizing after-tax wealth, is retiring at 60 actually better, or is retiring at 56, 52, or even 48 actually better in the long run? Okay, first, let's frame the comparison. Meet Mark. He's 48 years old, married, and has 2 kids that are still at home. He's been a senior executive at a SaaS company for the past decade. He has a W-2 salary plus annual bonus and RSUs vesting on a 4-year schedule. He has a meaningful pre-tax 401k, a taxable brokerage account with embedded gains, and a small Roth from early in his career. His household spends intentionally: school, travel, and a second home they're considering. He has enough to step back. The question is when. Scenario A is Mark exits at 48. His W-2 income goes to zero, and his taxable income drops significantly. And now he has a window, potentially 17 years before Medicare starts, where he's able to control almost every dollar of ordinary income that shows up on his tax return. Scenario B is Mark works to age 56. He captures more vesting, maxes out his 401k for another 8 years, and walks away with a much bigger balance sheet. But his planning window before Medicare, before Social Security, before required minimum distributions, that window is now compressed. Same person, same comp patterns, very different 25-year tax outcomes. Now, before we run both scenarios, let me give you a quick framework to understand why this distinction matters so much. When you're working with your full compensation package, you have almost no control over your taxable income. Your W-2 hits, your RSUs vest and are taxed as ordinary income, and you're sitting in the 35 or 37% federal tax bracket. The IRS is essentially a silent business partner, and you don't get a vote. But the year you exit corporate, that changes. For the first time in your adult life, you have some say on how much ordinary income shows up on your return. You can draw from cash and other after-tax accounts. You can realize long-term gains in years where your ordinary income is low. You can do Roth conversions, intentionally moving pre-tax money to Roth at tax brackets that you choose. And that's what I call the tax control phase. Phase 1 is your W-2 years, low control, high withholding. Phase 2 is the post-exit window, high control and high leverage. Phase 3 is after the age of 73, when the IRS requires minimum distributions and forces income again. And here's what matters for the 48 versus 56 decision. Phase 2 is finite. So every year that you delay your exit is one fewer year in the tax control phase. A few numbers to anchor this, and these are worth paying attention to if you're doing your own plan. In 2026, the standard deduction for married filing jointly is $32,200. The 22% federal bracket starts at $100,800 in taxable income. The 24% bracket kicks in at $211,400. And the 0% long-term capital gains rate applies up to $98,900 of taxable income for a married couple. What that means in practice: if Mark exits at 48 and carefully manages his income, he can potentially realize meaningful capital gains at 0%, execute Roth conversions in the 22 or 24% bracket, and stay well clear of the 32 and 35% rates that he was predominantly sitting in while working. That delta, the difference between being able to convert pre-tax dollars at 24% now versus being forced to take RMDs at 35 or 37% later, can be well into the 6 figures over a 25-year horizon. So let's now build the case for the earlier exit. The single biggest advantage of exiting at 48 is runway. You have potentially 17 years before Medicare starts. And you have 25 years before the RMD clock forces income that you don't get to choose. That runway is an asset, and most executives never quantify it. So here's what Mark can do with that runway. First, Roth conversions. Every year in phase two, Mark can move a deliberate amount from his pre-tax 401k or IRA into Roth. He's doing this at 22 or 24% today. If he doesn't do this, those same dollars will come out as RMDs at 32, 35, or 37% when he's 73. And that's assuming that tax rates don't go up. Layer on top of that Social Security income and Medicare premium surcharges. A longer Roth window means he can spread those conversions over more years, stay in a lower bracket in those years, and reduce the future RMD pressure significantly. Second is capital gains harvesting. Mark has a taxable brokerage with embedded gains. In the years where his ordinary income is lower, he can realize those gains at the 0 or 15% long-term rate. That's what I call bracket arbitrage, which is the practice of realizing income in the years where it's taxed least. And 8 more years of W-2 income means 8 fewer years of that opportunity. Third is ACA and healthcare. This one surprises people. Healthcare before Medicare isn't just a cost, it's a tax levy. Premium tax credits under the ACA are tied to your modified adjusted gross income as a percentage of the federal poverty line. If Mark manages his modified adjusted gross income intentionally, which is exactly what the tax control phase allows, he can significantly reduce what he pays for coverage each year. Exiting at 48 gives him up to 17 years to play that game. Exiting at 56 gives him 9. Now, a word of caution on the 48 scenario, because there are some real risks here. If Mark exits at 48 and doesn't plan carefully, he can accidentally create high tax years. Liquidating concentrated stock without a plan, stacking Roth conversions on top of capital gains, or triggering ACA repayment by misjudging MAGI, these are expensive mistakes that wipe out the advantage. So the early exit doesn't automatically win. It wins when it's backed by an intentional income plan. If you want a clear map of how to sequence income in that window, which accounts to draw from first, how to size conversions without stepping on each other, how to think about modified adjusted gross income relative to ACA thresholds, this is exactly the kind of work that we do in our wealth clarity process. The link is in the description if you want to map your level and see where you stand. Now, let's be equally rigorous about the case for staying through 56. Because there are real scenarios where working those 8 additional years is the right call. The most obvious one is equity. If Mark's vesting schedule is steep in his late 40s and early 50s, a multi-year cliff, a performance grant that pays out in year 7 or 8, then leaving early isn't freedom. It's giving back a known quantifiable asset. For some executives, the equity capture in those 8 years is worth more after tax than the entire Roth conversion runway. This is the math that you actually have to run. Second is the rule of 55. If Mark separates from service during or after the year he turns 55, distributions from that employer's qualified plan may be exempt from the 10% early withdrawal penalty. That's meaningful if his plan is to fund his lifestyle between age 55 and 59 and a half, when broad penalty-free access to retirement accounts doesn't apply yet. One important nuance. The rule of 55 is not a reason to retire at 55. It's a funding tool that makes the gap between 55 and 59 and a half more manageable if the rest of the plan calls for it. Third is the healthcare bridge. For some families, employer healthcare is a major risk reducer. If Mark or a dependent has significant health needs, the gap between group coverage and the individual market is real and expensive. Exiting at 56 means 9 years to solve for pre-Medicare coverage instead of 17. That's a significant factor. Here's the risk on the 56 side that most people miss. 8 more years of W-2 income means 8 more years of maxing pre-tax accounts. That sounds like a win. But if Mark's pre-tax balance is already large, adding to it without a conversion strategy creates what I call tax compression later. Bigger RMDs at 73, higher earn tiers for Medicare premiums, and potentially more Social Security exposed to ordinary income tax. The bigger the pre-tax pile, the more critical it becomes to have a plan to drain it. And a shorter runway makes that harder. Now I want to speak directly to the people watching this video who are already past 48 because the framework still holds. The variables just shift. If you're 50, you're still far from the rule of 55, so that's not yet a factor. Your Roth conversion window is still meaningful, potentially 23 years before RMDs if you exit now. The ACA runway is still long at 15 years. And at 50, the case for an early exit is very strong as long as your equity tail isn't too steep. If you're 52, the window compresses, but it's still significant. Roth conversions still matter. And at this age, I'd be asking hard questions about what vesting over the next 4 years actually adds net of taxes. If you're 54, the rule of 55 is a year away and worth modeling seriously. The ACA bridge shrinks to 11 years, still meaningful, but less room for error. This is often the age where I see vesting schedules peak. At 54, the equity capture decision is often the decisive one. The point is, every year you wait is one fewer year in the tax control phase. That doesn't mean waiting is wrong. It just means that the cost of waiting needs to be explicitly weighed against what you're gaining. So how do you actually find your right answer? Here's the scorecard I walk through. Factors that push toward an early exit include your taxable and Roth accounts can fund your lifestyle for years without heavy withdrawals from your pre-tax accounts. Your pre-tax balance is already large and you want maximum conversion runway to chip away at. You can control income tightly. No deferred comp payouts forcing a high MEGI in your first few years after exit. And most importantly, you value time, health, and family access now, and you have enough in a carefully modeled financial plan. Now, here are some factors that push toward a later exit. The next 2 to 8 years capture disproportionate equity value, and you've actually modeled what that's worth after taxes. Employer healthcare is a meaningful risk reducer for your family situation. Your financial plan isn't durable yet. You need additional accumulation to make the math work with margin. And the rule of 55 materially improves your funding bridge between 55 and 59.5. And then there are a few variables that either push or pull, but they are important ones. Concentrated stock and embedded gains. How and when you diversify that position and the timing of that relative to your exit can easily be a 6-figure decision on its own. If there's a state change on the horizon, the timing of that relative to income recognition matters significantly. Consulting or business income after exit. This is one people underestimate. If you exit corporate and immediately take on $250,000 in consulting income, that income needs to be planned around if the tax advantages of the early exit are going to materialize. So which is it, 48 or 56? There's no universal answer. And anyone telling you there is, whether that's the FIRE crowd saying exit as fast as possible or the conventional planning crowd saying work until 65, it's not solving your problem. What I can tell you is this: the 8-year window is real. The tax control window is real. The RMD compression risk is real. The equity trade-off is real. The only way to find your right year is to model your specific structure, your equity schedule, your account mix, your healthcare situation, your spending target, and run a multi-year tax projection showing you what each scenario actually costs. The best retirement age for you is the one that produces the best after-tax life for your situation. Not the one that sounds right in a Reddit thread, not the one your colleague chose, yours. So here's what I want you to take from this video. Your retirement date is a life and a tax decision. The window between when you exit and when the system starts forcing income, RMDs, Medicare premiums, Social Security taxation, is your most powerful planning window. And the length of that window is determined by which year you choose to leave. And if you're an executive in your 40s and 50s that's thinking about what a work optional life looks like, that is exactly the type of planning that we do. We take your specific variables and model what each exit year means for your lifetime tax bill and your after-tax net worth. Not theoretical, yours. And if that's a conversation you're ready to have, the link to book a free wealth clarity chat is in the description. You don't need more motivation to plan. You need the math and a clear path forward. Let's build it.